Hey, this is Brent from TradeGuild.net, and it is February 9th, and the wackiness in the market just continues, especially in the bond market. Last night I did a two-part video series. This is going to be a really short video, but I recommend that you check out the series. There's some very interesting things in there, there's some very dangerous things in there, and there's some opportunities. The market structure has changed tremendously. We're in a totally different market. Take a look at TradeGuild.net and our sister site, our member site, Wolf on Wall Street. You can learn about that at TradeGuild.net. Yesterday we had the 3-year auction, and we had the lowest participation of indirect bidders, which is foreign central banks, with very low participation in that 3-year. So today we have the 10-year, right? And the 10-year, we get record all-time highs. We had a $24 billion auction, and 71% of that was taken down by indirect bidders, meaning foreign central banks and the like. The direct bidders who've been supporting the Treasury bond purchases, I think there's about 42 of them, they came in at $118,000 of $24 billion. $118,000. Something is going on there. That is not natural. Portugal also had their auction on their 10-year hit all-time highs of 7.36. So don't be surprised to see the euro tank, contagion fears, and the fear cycle swing back towards Europe. Not only that, but we've got unrest in Yemen, Libya, Egypt, Syria, Iraq, Oman, Saudi Arabia, Algeria, Jordan, Morocco, Bahrain, Lebanon, the United Arab Emirates, Kuwait, Qatar, and even in certain parts of Eastern Europe. So things are changing in the world rapidly. Things are changing in the bond market rapidly and very, very strangely. Last night I showed you a bunch of charts that looked horrible. Cisco, they came out and they topped forecasts, and they closed at 2204. They're now trading at 1980. Last I checked. Over here it looks like they're up a little bit, but Cisco got whacked hard. That was one of the charts I showed you last night when I was talking about the difference between a stock market and a market of stocks, because there's a lot of stocks in the market. If you look at breadth, that is absolutely terrible. They look terrible. I listened to Bernanke today. I caught the Q&A portion of his testimony before Congress. And like I've mentioned, I think I mentioned in the video I talk about a lot on Wolf on Wall Street, that he seems dumbfounded when he's asked whether or not quantitative easing is having any effect or has any part to play or any responsibility in these food riots and unrest across North Africa and the Arab world. Again, he looked like a deer in the headlights, dumbfounded, and said something about monetary policy couldn't add 1 bushel of corn. Well, how about low rates and speculative activity that are driving up the commodities? And I showed you the CRB index yesterday, which is also going to put the squeeze on EPS. So you're going to see EPS downgrades in the stock market very soon as input costs are rising, and you can see that in all the ISM manufacturing reports. I don't know what he's looking at. He thinks inflation's subdued. The rest of the world is rioting. Now, this is an indicator. It's my proprietary indicator, 3C, and I generally just share this with members of Wolf on Wall Street. But I just want to show you something really quick. It detects accumulation and distribution through divergences. And what we're looking at right now is the S&P 500. And I'm going to pull up a daily chart of it real quick. What we're seeing right now is a divergence cycle. There's accumulation and then there's divergence, and it goes in cycles. It's just how the market works. So if we look back over here, we see where the cycle began, over here with accumulation, and over here with accumulation. And now we have entered the divergence part over here, the negative divergence, which is indicating distribution. So we're getting distribution in the market. Eventually it's going to lead to a reversal, and what I do is I go through these charts down through 60 minute, down to 1 minute, and generally speaking we can pretty much call these reversals. As a matter of fact, yesterday I said today wasn't going to be a good day in the market. Until the end of the day, it was not a good day in the market. Quickly, I just want to pull up TC 2000. It's the new version of Telechart. Go to my site. You can check out the links to Warden. It's just a phenomenal program. And here, looking at the SPY, check this out. We have a volume at price, right? Look at how the volume has just completely evaporated, as we've seen, especially in QE2 over here, as the primary dealers basically, in my opinion, are driving the market up with their POMO schemes. They don't need to buy the whole market, and they're not buying the whole market. They buy the weighted stocks like Apple, and they can lift the indexes while the rest of the market languishes. We've got ADX over here turned down from 42. Typically indicates the end of a trend, and we've got our vortex indicator over here getting into overbought territory. Over here it was in oversold territory when we started to bottom out. Just one last thing I wanted to show you was a Heikin Ashi chart over here of the SPY. Now this reads totally different than candlesticks. A quick explanation, I guess, would be to say that the tails, the long upper wicks, unlike candlesticks, when you see them in this kind of a chart, the Heikin Ashi chart, it's actually bullish, okay? And when you see these tails on the bottom in candlestick charting, that would be more of a bullish indication, but in Heikin Ashi, that's a bearish indication. And then we get candles, like stars, which are indecision candles. So today, even though we had that run into the close, we got volume up over here on what's pretty much been a pretty bad day all around until the close, and we've got a bearish indecision candle right there on this Heikin Ashi chart. In any case, the bond situation is what is really strange and kind of scary. You figure $24 billion on the 10-year as far as the issuance goes, and the primary dealers who've been supporting the Treasury and just flipping them right over to the Fed to be monetized after 2 weeks, they only take down $118,000, and we have an all-time high for indirect bidders, foreign central governments, taking down over 71% of that issue. So some very strange things are happening in the bond market, and some strange things are happening in the stock market. Members of Wolf on Wall Street, you know what I'm talking about, because you've seen the intraday charts and the signals that 3C's throwing out. We see what's happened to Cisco overnight here in after hours trading. I just want to tell everybody, please be careful. This whole buy the dip thing, it's just overdone. This is a chart that shows traders going in on margin. Over here's November 2008, and look at what has happened over here. Traders are just leveraging up on huge margin that we haven't seen since September 2008, and that was around the time the market was crashing. The market structure has been completely undermined by high frequency trading and algorithmic trading. There's just no liquidity provided anymore. You saw that with that volume at price chart I showed you just a few minutes ago. So just be very careful. If you want to get the bottom line on the complete wrap, you want some trades, we've got some great trades. We've identified some spectacular segments that are returning fantastic gains, like I showed you last night, over 640% less than a month. Go to tradeguild.net and check out Wolf on Wall Street. But that's going to be it for this video. Maybe I'll follow up in a day or two. Thanks a lot for listening, and enjoy the rest of your week.